Hi everyone, welcome to Thursday. Now today I'm going to show you Smart Invest. They are a series of ETFs that are based in the New Zealand market. And the reason I'm going to show you these is because I did talk about it on Tuesday when we were taking a look at the New Zealand market. Now, before we go into this, just remember that this is definitely for educational purposes only. No way is this intended to be personalised financial advice. If you're looking for that, and obviously go and have a chat to your own financial advisor. Right, let's get started and look at Smart Invest. So this is the homepage for Smart Invest. Now, they used to be called Smartshares, and I do tend to interchange that quite a bit. Old habits, as they say, die hard. Now, if I look along the top here, the second one in, funds and performance, let's click on that. And you can see here that they have over 40 different ETFs or exchange traded funds. You can search as well by categories. Obviously, we've got New Zealand, US, Australian, all sorts of different categories here. For the purpose of this, I'm going to click on US shares. And then what it does is it brings up the range that you can invest into the US market, but still be based in New Zealand dollars. And it gives you a little bit of a background about each one, what they invest into. Now, USF, that is the ticker code. And that, as you can see here, is basically tracking the S&P 500 index. So let's jump over to Yahoo Finance and we will put in USF. And because it's New Zealand, remember we do need to put in NZ. Right, you can see here that I have got the US S&P 500 up. So it's mirroring the S&P 500. Now, this is based in New Zealand dollars, so just remember that. Now, if I zoom in on here, this is on the 5-year charts. We do have weekly intervals. The thing that would automatically knock this out for me if I was looking to invest today is the fact that we've got these 3 red candles in a row. So it means that the market in the States has gone down for 3 weeks in a row. That to me would be an immediate red flag. But however, we're not doing this for the purpose of that. We're doing this to basically take a look to see how you can get exposure away from the New Zealand market, but still keep your money invested in New Zealand if that is what is important to you. Because I know a topic that comes up quite a bit, and it has been a lot lately, is the foreign investment fund rules and the tax regime around that. Definitely talk to your tax advisor regarding that because everyone's situation is different. But if this is a concern for you, this is a way that you can do it and you won't be exposed to those fifth rules because, like I said, it's donated in New Zealand dollars. Now let's go and put our moving averages on and let's just take a look and see what they're telling us. So remember, I used the 30 exponential, and then the other one is the 15. And whilst we've had 3 weeks in a row, the market is still trading above both of those moving averages, which is great. Back around this period, sort of June this year, you can see the 15-week crossed through the 30 and it carried on up. And it was a very strong, stellar run. And you can see that through here. Look at all these green candles, which are very attractive. It's what we want to see. They denote the market is traveling up. If we go onto the 1-year chart and just have a look at that. Now, this is where it is obviously getting a little bit more interesting. Basically, with last week, you've seen this market come off a little bit. And if you actually look up the S&P 500, you will see that it's come off since that, because some of this is because this is brought back to New Zealand dollars. It's not hedged, so you've got currency exposure in this as well, but obviously it's revalued every day back to the New Zealand dollars. So this is not having as much of a negative impact as the S&P 500 purely because our cross rate is quite weak against the US. So it means if you're bringing money back to New Zealand, you're actually potentially having a gain on that money, depending on when you invested it, of course. Now, a fund like this doesn't invest purely for currency or anything like that. It's just that it's revalued every day to whatever the New Zealand currency is at the time. But you can see here that it's started to turn on a daily chart. So that to me is something that I would want to just keep an eye on. Because if we take this off and let's go and have a look at the S&P 500. We'll just keep it on there, actually. I'll just take these moving averages off. And you can see by this blue line that the S&P 500 is well and truly at this stage underperforming the equivalent on the New Zealand market. And that impact is the impact of currency. So that is, like I just said, something that you do have to keep in mind. Let's have a look how it looks on the 5-year chart as well. And naturally, it tracks it, but it is slightly underperforming. Again, it's all back to that currency. That is a way, if you are interested, that you can get exposure away from the New Zealand market, but still keep your money based in New Zealand, and that's using Smart Invest. Remember to do your research though, because that's really important. Set your rules. Definitely use trailing stops because they will help you protect your capital in times of volatility. Probably if you're unfamiliar with trailing stops, then using an indexed fund, an ETF, is probably a little bit okay, especially if you're investing into something like the S&P 500, simply because over time it does outperform. Let's go back to the home screen of Yahoo Finance. If we click on the right-hand side here, it says US. If I click on this one, it's the S&P 500. It's the minis, what they call the minis. So it's just done at a fraction of the cost of the actual main board for the S&P 500. Right, now if I take this to all, you can see that even though we have periods of down in the S&P 500, and this brings these candles up to monthly, you can see that over time it will keep outperforming, even though you have periods of down like we had through here. 2008 was probably our biggest market fall that we've seen for some time. Then obviously through this period here, which was the beginning of 2020, we had the COVID, and that obviously really dropped the market, but then it's continued to run again. If I bring this back to the 5-year, we might be able to go back and just see. So you can see here, that was the impact that COVID had. And then obviously the market really rallied on again. So that's why investing into an indexed fund can certainly be a good way to get started. Your money is exposed, especially if you're investing into the S&P 500, across 500 different companies, not just a handful like we've got here in New Zealand. So I'm certainly pro doing something like that. And because over time, this type of investment generally does tend to keep performing, even though you have those periods of down. If you're unfamiliar with trailing stops, then for me, I am reasonably comfortable. But bearing in mind, this was quite a sharp drop that we had here through 2008 with COVID. But then, yes, the market rallied quite strongly. So that was what I really wanted to show you here. So like I said, it's an alternative to get away from the New Zealand market, give you more exposure to markets that are perhaps performing a lot stronger than our market. But hey, remember, if there is something that you would like to learn with investing, or if there's a share or anything you would like me to create one of these videos on, please let me know. I'm happy to do it, because at the end of the day, I want to make sure that you're successful in your investing journey. So until next week, take care.